Whether you're a complete beginner or have been investing for a while, building a long-term investment portfolio can be difficult. We're commonly told by many that one global fund is all you need, but we all know that there's constant temptations in the world of investing, so many funds to choose from, all doing different things, and we can experience fear of missing out, leading us to jump into whatever the latest hype stock is. Not to mention, many of us actually enjoy investing and like to experiment with a part of our portfolios. Even those who say they're global index fund investors usually end up having at least some other investments on the side for a bit of fun. The danger is that people over time allow their portfolios to become a complete muddle of overlapping funds, individual stocks, and total to tens or even in some cases hundreds of different positions, with no strategy or organisation in place. And this can prove to be unnecessarily difficult to manage and stressful to keep on top of. For this reason, complicated portfolios usually underperform benchmarks as well. So in this video, I'll go through a very simple strategy for constructing a long-term investment portfolio that gives you that reliable global diversification, but also room to put your own spin on things and satisfy that itch of trying to outperform the market. The truth is, you can allow yourself to experiment with your portfolio whilst remaining disciplined and actually understanding what role each position plays and how it all fits together. Having confidence in your portfolio can lift a huge weight off your shoulders and make long-term investing so much easier to stick to. This video is sponsored by Trading 212, the UK investment platform offering you zero commission investing. More on them later. So without further ado, the investment portfolio strategy I'm discussing today is the core satellite approach. Whilst I'm sure there's some interesting history behind the strategy and who came up with it, there's really no need to overcomplicate things here. It's called core and satellite because that is how it's best visualized. You have the majority of your portfolio in the core, like a planet, and then the remaining smaller parts of your portfolio in satellite positions can be visualized as operating around that core, perhaps seen as moons. This way of constructing a portfolio promotes sensible buy and hold investing in the core of the portfolio, but leaves some room to potentially boost returns with exotic satellite positions. For this reason, it can be considered a best of both worlds strategy. We'll go through specific examples of core and satellite positions later, but to summarize them now, the core is designed to provide stability and usually consists of simple global passive index tracking funds, with the idea that it acts as a long-term foundation of your portfolio that you never need to tinker with. You just keep on regularly buying into it and holding regardless of what is happening in the markets. On the other hand, the remaining part of your portfolio is in the smaller satellite positions that are more specialized and allow you to experiment and give in to your temptations of trying to outperform the market in a more controlled manner. These satellite positions are also not necessarily held indefinitely. You may wish to tinker with these satellites, switch them out, or reduce the allocation at any given time. You allow yourself that active control over the satellite portion of the portfolio. There's no set weighting you have to give to that core, but a common rule of thumb is 80% for the core and 20% for satellites. The exact allocation is up to individual investors, but I would say at a minimum the core has to be 60% and at a maximum 90%, because any less than 60% and it's not really a core, and any more than 90% and you may as well not bother with the satellites and just go 100% into whatever the core is. There are pros and cons of the core and satellite strategy, but I do believe the pros definitely outweigh the cons here. The pros are that it allows you to put your own spin on things by overweighting a certain part of the global market that you believe in, potentially obtain some extra diversification, and seek greater returns, all whilst having that reliable core to fall back on. By keeping the fun and experimental part separate and having a weighting limit in mind, it prevents our potential failings from impacting our long-term financial success. After all, there's a reason why low-cost passive funds are strongly recommended for investors of all experience levels. Those who try to outperform the market fail a lot of the time. Due to our monkey brains though, most of us know this and will try to do it anyway. Core satellite investing limits the negative impact of trying. However, that leads us nicely onto the cons of this approach. If it is so difficult to beat the market, then why bother with satellite positions at all? If one of the pros are that the satellite positions could potentially boost our returns, then one of the cons has to be that they could end up just being a drag on the overall returns of the portfolio. That is why it is important not to go too wild with your satellite positions. It doesn't matter if your satellites only have a 10% weighting, if you lose 100% of that money, then it's still going to have a significant impact. You should still be sensible to some degree with your satellite positions and not take on a ridiculous amount of risk. Overall, if you are someone that is happy with keeping things super simple and have no appetite for experimenting, trying to beat the market, or just having a bit of a more fun, active play with a part of your portfolio, then the core satellite approach is not for you. However, as I mentioned in the introduction, I think we have to be honest with ourselves, and the vast majority of us, myself included, like to have some part of our portfolio to play around with. I'm willing to bet some good money that YouTubers that advocate simple one fund buy and hold investing actually have some other investments on the side. Barely anyone actually keeps to one fund. Before going through how to structure a portfolio and examples of core and satellite positions, I wanted to thank Trading212 for sponsoring this video. As you may know, I've been using Trading212 since I first started this channel, with my second ever video being a Trading212 portfolio update. The fact that they offer a stocks and shares ISA with zero commission on trades, zero account fees, and one of the lowest foreign exchange fees on the market at 0.15% makes it one of the best investment platforms to use for building a long-term portfolio. However, it's not just about the low fees. Trading212 also has a number of innovative and handy features, and it is the pie feature in particular that is of relevance to this video. When you construct a pie, you can easily manage a multiple position portfolio by setting the weighting of each stock or ETF, adding or removing positions at any time, and being able to rebalance the weightings with just one click of a button. Resultingly, a pie is perfect for those using the core satellite portfolio strategy. It really couldn't be easier to implement and maintain such an approach on Trading212. So all of this together, alongside the many other great features, makes Trading212 well worth checking out. What's more, as a viewer of my channel, if you sign up to Trading212 via the link in the description, you can claim a free fractional share worth up to £100. All you have to do is complete the sign up process, verify your identity, and fund your account with at least £1. Alternatively, once you've got the app, you can go to the settings page, scroll down to the use promo code section, and type in my name, Tom, to claim your free fractional share within 10 days of opening your account. As always, remember that when investing, your capital is at risk, and for the offer, terms and conditions do apply. We now know what the core satellite strategy is, but to visualize things better, let's now have a deeper dive into some examples of what sort of investment fits into each category. So firstly, for the core part of the portfolio, we ideally want this to be passive, low cost, and global, because the idea is we never touch it, accept the returns of the market, and just regularly buy into it regardless of what is happening. Whilst Americans may argue that the S&P 500 is suitable for a core, and I don't think it's a terrible idea, we all know that the world is much bigger than just the USA, and there's no guarantee that American companies will always be the top performers. So for that reason, I'd argue that a global fund is better for the core of a portfolio. After all, the USA is so massive in terms of market capitalization that a global fund is usually at least 60% US stocks anyway, so I'm not exactly missing out if the US does continue to outperform. But I have the insurance that I have extra geographical diversification and should hopefully benefit regardless of what happens, as a global fund rebalances on my behalf. There's not just one possible global fund though, and there are a few different types that may be suitable for the core of a portfolio. Perhaps the simplest approach is an ETF that offers total market cap weighted global exposure, including both developed and emerging markets, like the Invesco FTSE All World, ticker FWRG. It has a total expense ratio of 0.15%, so at the moment it is currently the cheapest all-world ETF available for UK investors. A couple other example all-world ETFs are the Vanguard FTSE All World, ticker VWRP, and the iShares MSCI All Country World Index ETF, ticker SSAC. These have total expense ratios of 0.22% and 0.2% respectively. The next type of global fund that could be used as a core is a developed markets ETF. So, as the name suggests, these funds only include stocks from developed markets, but they're often marketed as global. Emerging markets are arguably not vital to having a core, and investors will have significant geographical diversification even without including them. Given the heightened uncertainty surrounding emerging markets, it may actually be preferable to allow yourself to make them optional and possibly include them as a satellite position that you can tweak. Some examples of low-cost, passive, market cap-weighted developed markets ETFs include the Vanguard FTSE Developed World, ticker VHVG, and the SPDR MSCI World, ticker SWLD. They both have total expense ratios of 0.12%. FTSE and MSCI do classify some countries slightly differently, but for the most part, these ETFs will include the same stocks at very similar weightings. These are just a couple examples, and there are many more developed markets ETFs available. Okay, the third and final type of ETF that I believe is suitable for a core is a global quality factor ETF. Two such examples are the Xtrackers MSCI World Quality ETF, ticker XDEQ, and the Wisdom Tree Global Quality Dividend Growth ETF, ticker GGRG. These have total expense ratios of 0.25% and 0.38% respectively. So these are still passive and track an index, but the indexes they track have additional quality filters such as high return on equity, low financial leverage, and stable earnings growth. The reason why you might want to go for a quality factor ETF in the core instead is that over the longer term, quality has been observed to outperform a standard market cap weighted index. It's one of 5 main research-based investing factors, and for a full run through of those, check out my factor investing playlist. Okay, so that's the core part of the strategy well covered, but we'll now move on to examples of satellite positions. It is impossible for me to go through every single category of satellite position because there's just so many alternative investments, and the exact point of it is that you can put your own spin on things. The options are endless. That being said, I will go through a fair few to give you some inspiration. Firstly, you may consider an actively managed fund as a satellite position. You may have a particular fund manager that you believe in, or identify a fund that you believe is placed to do well. As an example, you may be a fan of the Scottish Mortgage Investment Trust. This investment trust gives investors access to a high conviction global portfolio made up of public and private growth companies. They particularly focus on companies that they believe are able to disrupt the market and have huge growth potential. A quick look at the top holdings, you can see the likes of Mercado Libre, Amazon, the private company SpaceX, and ASML. The reason why active funds are satellite positions is because they can come with manager risk, their strategy may stop working at some point, or in the case of Scottish Mortgage, they can come with significant volatility and lack sufficient diversification to be a core position. Moving on, we'll now look at this diagram from Just ETF for inspiration of other potential satellite positions. We'll go through some examples of each category one by one. For country-specific ETFs, you may particularly believe in the USA and want to overweight that, so you could consider adding UC99 as a satellite position. This is a USA quality factor ETF that has historically outperformed the S&P 500 and has a total expense ratio of 0.25%. Alternatively, perhaps you believe India is well placed to outperform, in which case you could add the Franklin FTSE India ETF, ticker FRIN. This one has a total expense ratio of 0.19%. Next up, the factor ETFs. So I argue that quality could be a core fund, but other factors such as momentum and value fit firmly into the category of satellite positions for me. For example, we have the Xtrackers MSCI World Momentum ETF, ticker XDEM, and the SPDR MSCI USA Small Cap Value ETF, ticker USSC. They have total expense ratios of 0.25% and 0.3% respectively. As factors can come in and out of fashion, perhaps as a satellite position, you could attempt to adjust your weighting to these factors when you think they may outperform. Up next, commodity ETFs or ETCs. So there's plenty of different commodity ETCs to choose from, with probably the most popular being gold. And the iShares Physical Gold ETC is one such example, with a TER of 0.12%. As we can see on a 1-year chart, gold has done particularly well recently, but who knows going forward. Okay, whilst there are so many more possible examples, the last category I'll look at is sector ETFs, and you might include this because you believe that a certain sector is likely to outperform and want to place a small bet on it. The most popular one here is probably a tech ETF like the iShares S&P 500 Information Technology Sector ETF, ticker IITU, with a TER of 0.15%. This is technically both a country-specific ETF and a sector ETF in one. Another example of a sector ETF is the Xtrackers MSCI World Healthcare ETF, ticker XWHS, and a TER of 0.25%. There's so many more options here. That is a lot of examples, and I'm sure you get the idea by now. With those satellite positions, you really are just experimenting, using your convictions to put your own spin on things and trying to outperform the market. And just for a bit of fun here, let's now put a few of these examples together in a trading 212 pie to create and visualize a core satellite portfolio. Please do not copy this, as I have really not put much thought into it at all. It's purely as an example and for illustrative purposes. So I've gone for Xtrackers MSCI World Quality as my core at 80% weighting, and then I've included 5 satellite positions at 4% weighting each, with additional exposure to India, gold, US technology sector, Scottish mortgage, and a USA small cap value ETF. I have no idea whether this portfolio would do well going forward, but to be honest, I actually quite like the look of it to say I just created it in a few minutes now. On Trading 212, of course, you can always edit your pie later, add or remove positions, and if I actually had any money invested into this, I would then be able to rebalance the pie to different weightings if I wanted to. That is it for this video. Overall, the strategy is one of many, but I am a big fan of it, and I do think it is a great way of thinking about your investment portfolio. By categorizing your positions into core and satellite and deciding on a weighting, you can boost your confidence in your portfolio, reassure yourself that you're being sensible, whilst also allowing yourself that room to play around with and try and do that thing we all want to do, outperform the market. To reiterate one last time, remember that having the global core is not an excuse to make your satellite positions completely wild. It's always important to research every part of your portfolio, work out how it fits together, what correlates or does not correlate, and whether it places you in a good position to achieve your long-term financial goals. Now, don't forget my offer from Trading 212. You can claim your free fractional shares worth up to £100 by creating an account, funding it with at least £1, and using the promo code TOM in the settings page of the app. Let me know what free share you get. And as always, thank you for watching.